Good evening, everyone.
Good evening, Della. Brain Della Venunya. Afonama.
Maruku, I hope we are all doing well.
By the grace of God, and you?
I'm always fine.
You're always fine.
Yes, please.
You are blessed abundantly.
What can you do? If you are sad, you are not going to do anything about it. So you just have to be happy every day. All right. So let's speak about maybe some 5 questions here or some 6 questions. Then let's solve rolling questions on income taxes today. So we are going to pick question 1, 2, 3. Question 1, 2, 3, 11, 12, 13. Yeah, let's see whether we can solve 5 questions. All right. So someone should read the question 1 for us. Someone should read the question 1 for us.
IAS 12, income taxes, set out guidelines for dealing with under-provision and over-provision of income taxes by reporting entities. During the year 31st March 2019, Dealing Limited finalized and paid its liability for corporate tax on profits for the year ended 31st March 2018. An amount of 21 million. It had previously made an estimate provision for corporation tax of 25 million in the financial statement for the year ended 31st March 2018. The directors estimate the liability for the year ended 31st March 2019 at 24.5 million. Required. Explain the treatment of the above transaction in the financial statements of Dealing Limited for the year ended 31st March 2019 in respect of taxation.
All right. So what is the current tax estimate for 2019? What is the current tax estimate for 2019?
2019, the taxes.
The 31st March 2019, what is the current tax estimate? What is the amount that the company is estimating for tax for this year, which is 2019?
25 million.
No, please.
Oh, sorry, 24.5 million.
24 point what?
5 million.
5 million. You see, mostly you first have to identify the current reporting period, the current period of the entity. You can see that they're asking you to show the extract or explain for 2019. So it means that the current reporting year is 2019. So the question now is, they are saying something about the previous year. So if they are saying something about the previous year, that particular issue might be under provision or over provision. So let's take that part. During the year ended 31 March 2019, that is the current year, the Links Limited finalized and paid its liability for corporate tax on profits for the year ended 31 March 2018 at an amount of what? 21 million. So what was the actual tax paid for 2018 in this year?
21 million.
21 million. Okay. It had previously made an estimated provision for corporation tax of 25 million in the financial statement for year ended 31 March 2018. So the question now is the provision that they made in 2018. Provision in 2018 was 25 million. Okay. But the actual amount paid, actual tax for that particular year is now 21 million. What is happening there?
There's
Overprovision.
over provision.
There is an over provision. Okay. So if there is an over provision, what will be the effect of the over provision on the current or on the profit? When a company overestimates their tax liability or their income tax, what will be the effect on the profit?
It will
Profit
reduce.
will be understated.
Profit will be understated. So what we are going to do is that we have to go and add it back to profit, isn't it? So what we do with the over provision is that since the current year estimate is a cost and the over provision is a form of income, let's just go and net the what? The over provision against the current year what? Estimates. The question says that you should explain the treatment of what the above transaction in the financial statement of the Links Limited for the year ended. They say explain. They are not asking you to demonstrate. So the explanation that you are going to give is that there was an under provision relating to what? To the tax liability for 2018. How do you get that? You show there was an okay, the first one is there was over provision of 4 million. So you put into bracket how you are able to get a 4 million. So 25 minus 21. There was an over provision of what? 4 million relating to the previous year, which is the 2018 year end. Okay. So if there was an over provision, what would be the effect of that on the current year's what? Tax amount? So the first one, you have to tell the examiner what is the meaning of the amount that you first estimated and the amount that you are paying now. The difference is what? If it is an over provision, you say it and quote the amount. The next one is what will be the figure that will appear in their statement of profit or loss? What will be the figure that will appear there? In actual sense, if there was no under or over provision, the current estimate, which is 24.5, should be the figure taken to what? To the statement of profits for 2019. But there was over provision of 4 million. So what will be the figure that will go to the statement of profit or loss for the 2019 year? What will be the figure that will go?
5 million.
20.
20.5 million.
Okay. So you take your over provision from your estimate, 20.5 what? Million. So the company is going to charge 20.5 million to their statement of profit or loss for the year ended 31 March 2019. How did you get that? So if you are saying that they are going to charge this, then you put it in brackets 24.5 minus 4. So the company should charge what? 20.5 million as income tax in their statement of profit or loss for the year ended 31 March 2019. After you are done with the profit or loss, what will be the figure that will go to their statement of financial position as a tax liability for the 2019? What will be the figure that will go there? What will be the figure that will go to their statement of financial position, which is the balance sheet for the 2019? What will be the figure that will go as a tax liability? What will be the figure that will go as a tax liability?
20.5.
20.5.
No, please. We are having the 20.5 because the 4 million will be added back to profits and tax will be subtracted from the profit. So since we are doing it like that, let's just net the 4 million against what? The 24.5. Netting the 4 million against the 24.5 does not change the fact that you are saying that this year you are going to pay the people 24.5. So the figure that will always go to what is the amount that you are saying that you are going to be owing the tax authority this year?
24.5.
Yes.
24.5.
So even if you are overestimated your provision for last year, you are not giving cash. You are not giving cash for that. It's just an overestimation. So you just go and eliminate it. It doesn't change the fact that you are not going to pay the people 24.5 million for this year. So the 4 million was an overestimate that we make the last year, which we are correcting this year. But that does not change the fact that you are saying that you are going to pay the tax people 24.5 for this year. The 4 million was for last year. So this year, what is the tax liability that you are estimating? It is 24.5. So the current liability as a tax liability will always be the what? The current year estimate. If there is an under provision or over provision, it was relating to the what? To the previous year, which you have already paid for. But the only thing is the figure that you should charge to profit or loss, you have overcharged or undercharged. So you are only what? Reducing or increasing your profit with the undercharge or the overcharge. But the amount that you are going to pay the people for this year, the estimate will still be the same because that is the amount that you are saying that you are going to pay for this year. So the current year estimate will always be the tax liability. 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 So that is about the question 1. If they ask you to explain, first state whether there is an under provision or over provision. After that, what will be the figure that will be charged to statement of profit or loss as a tax expense? And what will be the figure that will be taken to statement of financial position as a tax liability, which will be a current liability? Let's take the question 3.
Village Limited is an agro-processing company which reports under International Financial Reporting Standards and prepares its financial statements up to 31st December each year. The company intends to comply fully with IAS 12 income taxes by introducing deferred tax in its financial statement. On 3rd January 2020, the company acquired an item of land which cost 750,000 Ghana cedis and has a useful life of 5 years with no residual value. Village Limited enjoys capital allowance at the rate of 30%. Revenue generated by using the plant is taxable, and any gain on disposal of the plant will be taxable, and any loss on disposal will be deductible for tax purposes. Village Limited estimates current tax provision for the year of 31st December 2020 at 10,425 Ghana cedis. The tax rate of Village Limited is 25% required. In accordance with IAS 12, income taxes explain the amount to be reported in the statements of financial position and statements of profit and loss for the year ended 31st December 2020. B. Required. Explain the term temporal difference and state one circumstance in which temporal difference may arise.
Okay. So you can see that they are saying that the company is buying or is acquiring an asset. Okay. The asset, the tax authority is going to give a capital allowance on that because they want to encourage investment in long-term assets. So they will give a capital allowance on that, and the company will also depreciate the asset over its useful life. So what is the useful life of the asset in the books of the company? What will be the depreciation for them? How many years are they saying?
5 years.
5 years.
So what is the tax? What is the capital allowance rate?
30%.
Okay. So if you change the 5 years to percentage, what will be the percentage every year?
20.
That will be 20%, isn't it?
Yes, please.
So since the depreciation rate and the capital allowance rate is different, there will be an issue of what? Defer what? Tax. There will be an issue of a deferred tax. So you first have to ask yourself, would there be a difference on the capital allowance that the tax authority will be giving and also the depreciation that the company will be charging? If they are all charging the same amount as capital allowance and depreciation, it means that there won't be any changes in the tax that the company is going to pay. So there won't be any issue with what? Deferred tax. But you can see that the company will be charging 20%, while the tax authority will be giving them what? 30%. They are giving 10% more, isn't it?
Yeah.
All right. So we first have to calculate our temporary difference and multiply by the tax rate. But I'm going to show you two ways of what getting the temporary difference. The first one is the simplest one. Okay, the company is charging a depreciation of what? 20%. The
20%.
tax authority is giving what?
30%.
30%. What is the difference?
10%.
Okay, it means that the tax authority is giving 10% more, and this 10% is what? The 10% over there is a temporary difference.
Temporary difference.
Is a temporary difference. So the question that you can decide to find 10% of the cost of the asset, or you find the carrying value separately and also the tax base separately and subtract. So we are going to do all the two. So we are going to do all the two. Okay. The first one, let's just find the temporary difference by using the 10%. Then we go the normal way by finding the carrying value and also the tax base and find the difference. So let's find the temporary difference. The temporary difference will be 10%, 0.1 times the cost of the asset is what?
750,000.
750,000. Okay. What will be the temporary difference?
75,000.
75,000.
Okay. So our deferred tax will now be the tax rate multiplied by the temporary difference. So the tax rate is what?
25%.
So 0.25 times 75,000. What are we getting?
18,750.
18,750. Okay. That is the simplest way to go about it. But another way is the person can decide to find the carrying value of the assets. In the books of the company, they will find the carrying value of the assets. And the carrying value is calculated as the cost minus what? Accumulated what? Depreciation. So the asset was bought on January 2020, and we are to show this on 31 December 2020. So it means that the asset was used for only what? 1 year. So we can say that the cost of the asset, the carrying value of the asset is 750,000. 750,000 minus 750,000 divided by 5. Divided by 5 is the 1 year depreciation. Is the 1 year depreciation. What will be the total that we'll be getting? Or you can find the depreciation for 1 year and subtract it from the cost. What are we going to be getting?
$125.
Now, if you subtract it from the 750, we are looking for the carrying value. Straightforward.
600,000.
600,000.
600,000. Okay. So 600,000. So this is our carrying value. Let's go and find the tax base. Let's go and find the tax base in the books of the tax authority. The tax base is the carrying value in the books of the tax authority. So the tax base will also be the cost minus accumulated capital allowances. So the cost will still be the 750,000, but this will be minus 0.3 times 750,000. What are you going to get?
525,000.
525,000. So 750 minus 0.3 times 750,000. So 520 what? 5. Okay. So we can find our temporary difference now. Our temporary difference is calculated as the carrying value minus the tax base. So the carrying value was 600,000 minus 525,000. The difference will be what? I'm sure it will be 75,000.
Yeah, 75,000.
Okay. So from this side, then you can find your deferred tax by multiplying your tax rate by what? The temporary difference. Okay. All right. But the deferred tax, is it going to be a deferred tax asset or deferred tax liability?
Asset.
Are you
It's an
sure?
asset.
Are you sure?
Yes.
Are you sure?
Yes.
Who is going to enjoy in the future? What we are looking at right now? The tax authority is giving a capital allowance of 175,000. The tax authority is giving a capital allowance of what? What is the 30% of the 750? They are giving capital allowance of 225,000.
225,000.
And the company is charging 150. In the future,
150.
we're going to suffer.
The company will suffer
suffer.
in the
The company will suffer. It means that the company will be paying for the benefit that they are enjoying today in the future. In
Yeah.
that case, it should be a deferred tax liability. But if it is the company that is going to enjoy in the future, then the company will be getting some what we call the tax benefits. That will be the deferred tax assets. That will be the deferred tax assets. Or basically, when the carrying value is higher than the tax base, the difference is what we call taxable difference, which will give rise to what? A deferred tax what? Liability. Okay. Tete, your hand is up.
Okay, so if you say the company is going to suffer in the future, what do you mean by it?
No. In the books of, in terms of paying tax, the tax authority is now giving 225,000 as a capital allowance in relation to the asset that the company is what is using, but the company is charging only 150,000. So the meaning is that maybe by the end of 3 years, the company will not get any capital allowance on what? On the asset again. So that portion of the capital allowance will not be available, which is going to reduce their tax liability. It will be exhausted. So the company will be paying a higher tax in the books of the tax authority than what they will be thinking that they are going to pay.
But won't that be a credit in their books with the GRA?
No.
In their file?
The GRA has given you all the benefit that you are going to enjoy on the asset. Whether you are still using the asset, the GRA, if they have fully depreciated the asset in their books, there is no way they are going to give capital allowance on that asset again because you have already enjoyed the capital allowance done. You should.
So what I'm asking is that, let's say instead of charging 225 for depreciation, they did 150.
Okay.
So a part of, I mean, this 75 has been taxed, which shouldn't have been so.
It has not been taxed. The tax authority is giving you a capital allowance of 25. It's not the tax that the company is going to put in their financial statement. We are not more concerned about that.
Yes.
Our
But what
concern
I'm
is
saying is that
yeah.
the company expected you to deduct 225 and then you did 150.
No,
so that's 70.
It's not the tax authority that is giving the 150. It's the company that is charging their depreciation of 150 every year. The tax authority is giving them 225 every year.
Yes, I get it. But what I'm saying is that instead of 225, sorry, so the tax is giving them 225. They
Yes,
did
please.
150.
Yes,
They
please.
finished their books. They've paid whatever they need to pay to GRA with
They will not pay.
respect
The
to
GRA, they will not pay. The GRA will now take their books and now do the vetting. They will allow and disallow some of the expenses. So the GRA will
Yes.
add the 150,000 back to their profit and now subtract 225 from their profits as a capital allowance before they will charge the depreciation, before they will charge the tax on the chargeable income. So the company is expecting the GRA to charge 150 as capital allowance. If that happens, then the company is going to pay a higher tax for that particular year. But the GRA is now giving them 225,000. Now their tax liability is going to reduce because the GRA is giving them more capital allowance. The capital allowance will be taken from profit before they charge the tax. So if the GRA should be charging 150, it means that the tax that a company will be paying if the GRA is charging 225 will be lower than if the GRA is also charging what? 150. It means that the 75,000 difference over there, the GRA will not charge it and they will charge tax on it. But the GRA is giving them the 75,000 now. The company is enjoying that 75,000 in addition. The meaning is that in the future, the 75,000 will not be there.
Okay, but in practice, you see, when we are filing the return, we estimate and pay.
Are you talking about company tax?
Yes.
Or you are talking about individual returns?
I'm talking about company tax. Say we file at the end of the year. So if let's say I'm filing by April, I've done my books. I know that I'm charged at 25%. I charge 25% of my profit, and I pay before GRA will come and do tax.
That is not what for what you are doing. It's not what the most of the company they do. They don't know their profit before making the estimate. Okay, or you go with that one too. But what they do is that they make the estimates based on previous or their budget. Not that they will prepare their financial statement before they will charge the 25% on it. They mostly make the estimate based on maybe the budget or something like that. But you can still go ahead with the explanation. Yeah, so now you can still go ahead with you have charged the 25%. Okay.
Yeah, so you've charged 25% on it, and then you've made payments. Mind you, in the year you've made quarterly payment per the estimate at the beginning of the year. Okay. So whatever difference is left, you've paid to GRA as at April the next year. Okay. Now you are done paying. They've come to do their assessment. They give you this capital allowance of 225. That means you've overpaid them. You understand? So how does overpayment become a liability?
You say that you overpaid them. The GRA will not, you are going to pay some amount of the money. You are not going to pay the full liability that you are saying that you are going to pay them. Is that how you could do it? You are going to pay the full amount?
So let's take a typical, let's say for the year, for this year, you understand? For this year, I envisage profit of, let's say, 100,000. Okay. I know that 25% will go to GRA. So first quarter, I pay a quarter of it. Second quarter, I do save. Third quarter, I pay a quarter of the 25. And then in April, I pay the final one with respect to the actuals. So if let's say my estimation hits spot on and I'm able to make 100 CD profit, that means I'm left with the fourth quarter of the 25 CDs to pay. Now, I've filed my returns for this year in April next year, and then I pay the difference. GRA comes, they give me a capital allowance more than the depreciation I've charged in my account. That means per the 25 CD I paid as corporate tax, I overpaid.
Okay.
I don't know if I'm making headway with this.
Yeah, that what you are saying it means that you are paying, isn't it? You have already paid for your tax liability.
Yes, I've paid.
Okay. The situation that we are looking at over here, the company will not pay any amount. They will wait till the GRA will give them the final payment, then they will pay. So they are not going to make any upfront payment. They are not going to pay anything. But they will wait till the GRA will give them the tax liability, the actual tax, then they will pay. So the one that you are giving, if that is the case, that will be an overpayment. But in this case, they are not going to pay anything till the GRA will give them the amount that they are going to pay. That is the assumption under the income tax. The company will not make any upfront payments. The company will not make any upfront payments. They will wait for the GRA to give the tax amount. then they will now pay. Then they will now pay. Okay. But what you also said is a situation of under provision and over provision. It will be treated as under provision or over provision. Okay. Your situation will be like under provision or over provision. But if you come to the issue of the deferred tax, we are looking at the company is not going to pay anything, but the one thing that is causing the difference between the tax for deferred tax, what we assume is that the actual estimate that you are having is maybe the same as there is nothing that is going to affect the current tax. There is nothing that is going to affect the current tax. But the only thing that will cause a difference between your profit, your accounting profit, and the taxable profit, that is the part that we are interested in. So your situation will be like what you said will be like under provision or over provision. It will be treated as under provision or over provision. All right. Okay. So this will give us a deferred tax liability of 18,750. Okay. So in the statement of profit or loss, deferred tax will always be adjust against the current tax. Deferred tax will always be adjusted against the current tax. If you look at the question, what is the current tax there? What is the current tax for the year?
10,125.
So 10,125.
10,125.
So 10,125. If you add the 18,750 to it, how much are you going to be getting?
28,875.
28,875.
875.
So in the statement of profit or loss, the company will charge a current tax of 28,875. So the deferred tax will be added to the current tax. If it is a deferred tax liability, it will be added to the current tax. So the company is going to charge a current tax of 28,875 in their statement of profit or loss. But if you go to statement of financial position, what will happen there? What will be
That
sent?
is the
So
tax
you
of
recognize the
18,750.
Okay. What will be the current profit and what will be current liability and what will be non-current liability?
so the
The tax
18,750 will be
estimate for the year,
non-current liability.
Okay. 18,750 will be a non-current liability.
Non-current liability, and
Okay.
10,125 will be a non-current asset.
No, please.
is the tax estimate for the year. That's the 10,725 will be the current liability. Then the 18,750, that's the deferred tax will be the non-current liability.
Exactly. The current tax will always be the current liability because it might be paid within the 3 months in the next year. But the deferred tax liability will be there and it will be exhausted over the useful life of the asset. So the deferred tax will be there. The creation of deferred tax will be there up to 5 years. So that will be treated as non-current liability. Non-current liability. Okay. Yeah, Sinatete. Sinatete.
Yes, sir.
Yeah. Okay. You see, if you come to the deferred tax, our concern is we don't look at the benefits or the cost, like under provision or over provision. Okay, we just look
Okay.
at the implication that some of the items that are allowable for tax purposes, what will be the future implication of them? So we look at the implication of those items. Look at the implication of those items. So if there will be any benefits or any additional cost, that will be treated under the current tax, other provision or over provision. So the deferred tax, our concern is we want to know the future consequences of what the thing is costing today. That is the purpose about the deferred tax. So if the company is taking more capital allowance today, what is the future implication of that? It means that they are going to pay more tax in the future as a result of that particular one. So the deferred tax is all about we estimating the future consequences of the event that is happening today. That is happening today. All right. Let's take question 4.
Okay, thank you.
All right. Let's take question 4.
The BSD valued its property, plant and equipment upwards to 950,000 for the first time on the 1st December 2015. Its reporting date. Prior to the revaluation, the carrying value of the property, plant and equipment was 850 and the tax base was 625,000. The BS tax rate is 25%. If deferred tax liability brought forward in respect to property, plant, and equipment was 62,000 Ghana cedis required. Prepare the journal entries required to record the movement in deferred tax in the year ended 31st December 2015, the financial statements of WS Limited.
Okay. So they are saying that the company has revalued their assets for the first time, isn't it? Okay. What is the revalued amount? At the end of the reporting period, what is the revalued amount? 950,000. So the revalued amount was 950,000. But before the revaluation was done, what was the carrying value?
850.
850. Okay. So what will be the revaluation surplus here?
100.
The revaluation surplus will be 100,000. Okay. You see, whenever there is a revaluation, the revaluation will automatically increase the carrying value of the asset by the revaluation amount. The tax authority is not going to revalue the asset. Tax authority does not revalue an asset. So whenever there is a revaluation loss or revaluation surplus, it will automatically create what we call a deferred tax what? It will automatically create what we call a temporary difference. Okay, so whenever you are given a revaluation amount, try to ask yourself the time that the revaluation was not done, what should have been the temporary difference, which will go to profit or loss. But after the revaluation, what is now the temporary difference? So what you do is that if the revaluation was not done, the carrying value of the asset should have been what? 850,000. Okay. The tax base is what?
625,000.
625,000. So the temporary difference relating to what? Profit or loss will be how much?
225,000.
It will be
225,000.
225,000. Okay. That is the temporary difference relating to profit or loss. That will be the portion of the deferred tax that will go to profit or loss. Okay. The revaluation surplus will automatically create a temporary difference because the tax authority is not going to revalue the asset. In actual sense, after the revaluation, the carrying value of the asset, the new carrying value would have been what? 950,000, and the tax base will still remain what? 625,000. In this case, you will see that the temporary difference is now 325,000. Out of these 325,000, 100,000 is relating to what? Revaluation surplus. So we separate this, we take the revaluation surplus separately and know the what? The temporary difference that would have been created for profit or loss. And that will be the 22,500. So we calculate deferred tax in two forms. The one that will go to profit or loss and the one that will go to other comprehensive income. So the deferred tax for profit or loss, deferred tax for profit or loss, deferred tax for profit or loss deferred tax for profit or loss will be equal to, what is the tax rate?
25%.
So 0.25 times 225,000. That is the difference caused by the profit or loss. The question you ask yourself, assuming the revaluation was not done, what should have been the temporary difference? That particular temporary difference is the one that is relating to profit or loss. Is the one that is relating to the profit or loss. So what will be the figure here? What will be the
625. 56,250.
okay 56,250. Okay, let's come to other comprehensive income. The deferred tax will automatically be calculated on revaluation surplus. So 0.25 times the difference caused by the revaluation surplus. That will be 25,000. Are we okay with that? All right. Let's read the other part. Each deferred tax liability brought forward in respect to property, plant, and equipment was what? 62,000. That particular 62,000 balance on the deferred tax account, is it relating to profit or loss, or is relating to both profit or loss and other comprehensive income? The 62,000 difference there.
It's profit and loss.
It's profit or loss because that was a balance before the revaluation. So the question says that there was no prior revaluation, or the revaluation was done for the first time. It means that the opening balance on the deferred tax account, there is no revaluation surplus or deferred tax for revaluation surplus including in the opening balance, because the company is what? Valuing their asset for the first time. So the 62,000 over there, which is the opening balance, is relating to what? Previous deferred taxes relating to profit or loss. But what is the new deferred tax relating to profit or loss now? What is the new deferred tax relating to profit or loss now? So the balance brought down on deferred tax was 62,000. The new provision now is what? 56,250.
This is 250.
Is it increasing or reducing?
Reducing.
It's
Yes.
reducing. It's reducing by how much?
$5,750.
5,750.
750.
If there's a reduction in provision, what is the effect? If there's a reduction in a provision, what is the effect on profit?
It increases profit.
It increases profit.
So the deferred tax will also be treated as a provision. The deferred tax is a provision. It's a provision. So if it increases, then increase by how much? You take that particular increase. If it reduces by how much? You take it to profit or loss. So what will happen is that they say you should prepare a journal entry. You can see that in this case, they haven't given you the current tax. So prepare a journal entry to record the movement in deferred tax in the year ended 31 December 2015. So our balance on deferred tax account, the deferred tax liability account, is 62,000. Now it has reduced by what? 5750. So what are we going to do? We are going to debit the deferred tax account, isn't it? Are we going to debit?
Yes, we are going to debit it.
It's a liability. So you debit
It's just
deferred
a
tax.
credit balance.
Okay, you debit a deferred tax liability account, debit deferred tax liability of 5750. Or you can say that you are going to debit what? Profit or loss. Okay, no, if you are debiting profit or loss, means that you are trying to treat this one as an expense. So you debit deferred tax liability of 5750 to reduce the 62,000 to what? 57250. Okay, another one is what? You debit other comprehensive income of what? The revaluation surplus deferred tax, which will be 25,000. Are we okay there? Are we okay with
So
the
where would the
25,000?
other leg go?
The other leg, we will bring it now, and the credit, we bring the credit now. Okay. So the credit, you credit profit or loss with 5750. The reduction is an income, isn't it? All right. The 25,000 will increase the deferred tax account. So you credit deferred tax liability, because the deferred tax liability is going to increase by the 25,000. So this is how the journal entry will be done. The deferred tax, the 62,000 reduced by 5750, but the 25,000 is a new deferred tax which will reduce our revaluation surplus in other comprehensive income. Then the reduction in the deferred tax, is an income, it's a form of income. So you credit profit or loss, and the 25,000, which is other comprehensive income, is addition to deferred tax. So you credit the deferred tax too. So if you come to statement of profit or loss, they say you should show statement of profit or loss. You have movements in deferred tax, which is a reduction. Movements in a deferred tax of 5750. That will be income. If you come to other comprehensive income, you have your revaluation surplus. Of 100,000. Then you subtract your deferred tax from it. 25,000. Okay. If you count your statement of financial position, you are going to have assets, which is PPE. You are going to have your PPE. Of the PPE will be how much? Our PPE will be 950,000. Am I correct? The revaluation was done at the end of the year. So we have assets as PPE. Then we now have liabilities. We have liabilities. The liabilities, we are going to have a deferred tax of 56,250 plus 25,000. The new deferred tax for profit or loss now is 56,250. But the deferred tax relating to the other comprehensive income is 25,000. So the total deferred tax will now be profit or loss plus what? The revaluation surplus. If you count to the equity component, you show your revaluation surplus net of deferred tax. That will be 100,000 minus 25,000, and that will be 75,000. The revaluation surplus will always be shown net of what? Tax. Net of tax, which is a deferred tax element on that. That is the deferred tax elements on that. So this will be 81,250. All right, let's take, for those who are doing financial reporting, this is how your question. Yes, please.
So what's the difference between the question 4 and 3? Because with the question 4, we just calculated the difference between the balance brought down and then the current year.
Okay.
And that gave us the 5 something. But with the question 3, you added the 18,750 to the 10,125.
Yeah,
to give us a total deferred tax.
Yeah, because you are giving a current tax. This question, we are not giving a current tax. So if you are giving a current tax, the deferred tax, the reduction in the deferred tax will be subtracted from the current tax. If you are giving a current tax, then the movement in the deferred tax will be adjusted against the current tax. But since we are not giving a current tax, we just take the reduction to profit or loss straightforward. And the 25,002 is as a result of our revaluation. You can see that question 3, there was no revaluation. Yeah. So if you are given a current tax, the movement in deferred tax will be added or subtracted from the current tax before you take the net figure to profit or loss. So if the question should have given us a current tax of 15,000, it means that the deferred tax over there, if the question should have given us this of 15,000, 15,000, if they should have given a current tax of 15,000, the deferred tax, the movement is like income. So this will be subtracted from this figure. Then we take the net to what? To the profit or loss. To the profit or loss. So the movement is always adjusted against the current tax. It's always adjusted against the current tax. But this one, we don't have the current tax. That's why we just took the 550, the 5750 to profit or loss straightforward. All right. Let's look at the question 5. Question 5.
ST has unused tax losses of 150,000 at its reporting date, 31st December 2018. It estimates that it will make profits of 120,000 over the next 5 years, but cannot be certain of profitability beyond 5 years' time. The corporate income tax rate is 25%. Calculate the deferred tax assets that should be recognized in ST's statement of financial position at 31st December 2018 in respect of the losses.
So we say something about what? Relief what? Unrelief losses, isn't it? Where if a new company, a startup company, mostly in your first or in your few years in your start or in the first few years of your operations, you are likely to be making losses. So the tax authority will allow you to carry those losses forward and deduct it from profit. But if the losses are going to be deducted from profit, it means that the company will not be paying taxes as a result of these losses. So if the tax authority is not allowing you to deduct the losses, it means that whenever you make a profit, the full profit will become available for tax purposes. But the tax authority is allowing you to what? To deduct the losses. So it means that when you make a loss of 5,000 and you made a profit of 5,000 in the future, it means that you are not going to charge any what tax on that particular 5,000 profit. And you can say the company is enjoying what? A benefit. So that benefit that the company is going to enjoy in the future, we just want to know the implication of that today. So what we do is that whenever there is losses, it is the company that is going to enjoy the tax benefit. So it will always be a deferred tax asset. But you cannot just stand up and start make provision for a deferred tax asset on all the losses. You can only make the provision to the amount that the company is certain of what? Making profit that the losses can be written against. So the total losses in the question is what? 150, isn't it? The total losses in the question is 150. But the company is certain of making profit up to how much?
120.
So it means that the benefit that you are going to enjoy will be only on what? 120, isn't it? The 30,000 will not be what? You can't make profit to cover the 30,000. So we are going to make the provision for the deferred tax asset based on the what? The 120. But if the company can make a profit of 200,000, it means that they are going to subtract all the 150 from it. So we make the provision or we calculate the deferred tax on all the 150,000. So the question 5, what they are asking you over there is to calculate the deferred tax assets. The deferred tax asset will be calculated on the losses that a company is certain of making what? Of making to write their losses against. So that would be 0.25 times what? 120,000. How much are we getting? How much are we getting there?
30,000.
30,000. Okay. This 30,000 is a future benefit. So what will happen is that the 30,000 will be treated as income in the statement of profit or loss because it's a company that is going to enjoy this in the future. So this will be treated as what? A deferred tax benefit in the profit or loss as income. But if you are given a current tax, you subtract it from the current tax. So this will be treated as income, this is what we call a deferred tax one, or a temporary or a deductible temporary difference, a deductible temporary difference, a deductible temporary difference. And this will be shown as a non-current what? Asset. This will be shown as a non-current asset, which will be a deferred tax asset, because these losses will be carried over for 5 years. The company is estimating to make the profit over the next 5 years. So it's going to be for the future. Therefore, it should be shown as what? A deferred tax asset. A deferred tax asset. So when the company is the one suffering the loss today, it means that they will be compensated for that particular loss in the future in the face of the tax authority. In that case, the company should recognize a deferred tax asset, and the provision should be recognized as income in the statement of profit or loss. But if it is a company that is on the receiving side today, the tax authority is giving them more benefits today, then it means that in the future, the tax authority will be the one to enjoy. So the company will make provision for that particular suffering that they are going to make in the future. Therefore, that will be shown as a deferred tax liability and as an expense in the statement of profit or loss. Let's take question 6, which will be, this is how the financial reporting, the final account question, this is how it will be structured. Question 6.
A company's trial balance shows a debit balance of 2.1 million brought forward on current tax and a credit balance of 5.4 million on deferred tax. The tax charge for the current year is estimated as 16.2 million, and the carrying amount of the net assets are 13 million in excess of their tax base. The income tax rate is 30%. Required, in accordance with IAS 12, income taxes, explain the amount to be reported in the statement of financial position and statement of profits and loss.
Okay. So, yeah, HP.
I can hardly hear her read. I don't know
Okay.
if my end is.
Yeah. That's why you are saying that if I don't know. So my side is very clear. My
I
side is
mean,
very
your
clear.
side is correct. Yes,
Yeah. Do you have the question?
I do. I've printed it. Correct.
Okay. So it's question 6. So whatever you are seeing
All
over
right.
there is the same thing that she's reading. All right.
All right.
Okay. So the question is, this is those who are writing financial reporting. This is why your final account question on current on IS12 will come. This IS will come, and there won't be a financial reporting final account question without PPE and income tax. Okay, you can't deal with those two. You can't prepare account without those two. All right. So let's come here. They say a company's trial balance shows a debit balance of 2.1 million brought forward on current tax and a credit balance of 5.4 million on deferred tax. Those balances are the opening balances, isn't it? If we have a debit balance on tax account, what is the meaning? If we have a debit balance on a tax account,
Under
if
provision.
that will be under what? Provision.
Under provision.
Yeah. If you have a debit balance on the deferred tax on the current tax account, it will always be what? Under provision. Okay. It can also be a tax asset. It can also be a tax expense paid. But in this case, we assume that is what? Under provision. So in the financial reporting class, this is how you are going to prepare it. We prepare tax schedule. Tax schedule. Okay. Another tax schedule, you bring your current estimate. You bring your current estimate. So what is the current estimate for this year? What is the current tax estimate? It will always be given to you in the question. What is the current estimate? What is the current estimate?
16.2 million.
16.2.
Okay, 16.2. Okay, the debit balance is what? It's under provision, isn't it?
Yes, sir.
Are we going to add the under provision to the current year estimate or we subtract? Under provision.
We add.
We are going to add because that should have been subtracted from our profit, but we didn't subtract it. Since we are going to subtract the current estimate from profit, let's go and add it and have the total amount that we are going to subtract. So we have 2.1. Okay, let's now come to the issue about the deferred tax. And the carrying amount of net assets are 13 million in excess of their tax what? Base. The question is it the tax base that is higher than the carrying value or the carrying value is higher than the tax base?
The carrying value is higher than the tax base by
So,
13 million.
So the 13 million over there is a temporary difference. The question has calculated a temporary difference for you already.
Yeah.
And they are saying that the tax authority is giving a more capital allowance to the company than the company is depreciating the asset. So that is why the carrying value is higher than what? The tax base. So that is a temporary difference given to you over there. The difference between the carrying value and the tax base is the 13 million given to you. So what you do is that you just calculate your deferred tax straightforward. So let's calculate the deferred tax on that. The deferred tax will be 0.3 times the 13 million. What are we getting?
$3.9 million.
3.9 million. 3.9 million. Okay, this is the new provision now. But the question is, what is the opening balance on the deferred tax account?
2.1.
Deferred tax account.
Sorry, 5.9.
5.4.
5.4.
Okay. But now the new provision now is what? 3.9. What is happening?
There is a reduction.
So we bring movement in deferred tax here. So you show the reduction. The reduction will be 5.4 minus 3.9. What will be the reduction amount?
1.5.
So that will be again, isn't it? So we take it from our tax schedule. So you add all these amounts, the figure that you are going to get now, that will be the figure that will go to profit or loss account. That will be the figure that will go to profit or loss account. In the financial reporting, your tax schedule will always be like this. The current year estimate, then you take under or over, you add or you subtract. Then you look for the balance on the deferred tax account, and you also estimate the new provision. Deferred tax will be treated as a provision. So the 3.9 is now the new provision. The question is, what was the provision that we first made? It was 5.4. Now we are saying that the new provision is 3.9. It means that we have to reduce the 5.4 to what? 3.9. And that reduction is again, we should be taken to profit or loss. But since we have a tax which is an expense, let's come and subtract the gain from the tax and have our net amount that will be taken to what? Profit or loss. That will be taken to profit or loss. So what will be the amount that will be taken to profit or loss?
16.8.
16.8. So this will be the figure that will be taken to profit or loss. 16.8. But if you go to statement of financial position, what figure are you going to show as a current liability for current tax? What figure will be for
16.2.
16.2? That is correct. The current estimate. What will be for the deferred tax liability as a non-current liability? What figure are we going to show there?
3.9.
3.9. That is all. All right. So those who are doing financial reporting, final account, this is how you are going to present your tax schedule. The current estimate, you add under or subtract over. Then the movement in deferred tax will be adjusted against the current tax because they are all talking about tax. Let's pick additional 2 questions. Then I want to say this. Land is not depreciable. Land is not depreciable. All things being equal. The freehold land is not depreciable. If it is a leasehold land, then the difference will be the normal difference because the company will be depreciating the land. So the difference will be the normal difference. But if it is a freehold land, the land will not be what? Depreciable. But what is going to happen is that when the company decides to revalue the land, you know that the revalued amount will automatically increase the tax base of the asset. So when there's a revaluation of the land, we estimate the deferred tax liability on only the revaluation amount. Because if the land is 20,000, in the books of the tax authority, it will still be what? 20,000. But as soon as the company revalue the land to what? 30,000, it will increase this one by what? The tax authority will still be having 20,000. So that will increase by 10,000. So the 10,000 will be creating what we call temporary difference, which is as a result of the revaluation. So we estimate the tax liability on the revalued amount. Okay, let's come to question 12. Question 12 and 13. Let's take those two. Question 12 and 13.
The financial account of Abodie Limited is finalizing the financial statement of Abodie Limited for the year ended 31st August 2021. The following items are being considered for deferred tax purpose. 1. At year end, Abodie Limited's property, plant and equipment had tax base and carrying value of 72 million and 95 million respectively. The company's provision for decontamination cost was 11 million, appropriately discounted at the year end. Decontamination costs are tax deductible when paid. The company had inventory with carrying value of 24 million. This did not agree with the tax base because of 3 million written down value for obsolete items. Tax relief is only granted for inventories upon sale. The company incurred 15 million in respect of new software development during the year, which was capitalized and will be amortized over the next 5 years. Full year's charge is required in the first year of completion of purchase. This cost was deducted in the current year for tax purposes. The company is liable for income tax at 30% required. Computes the company's deferred tax liability at 31st August 2021.
Okay. What I want to say is that as soon as the question says that this particular item is tax deductible or is allowable for tax purposes or it will be tax something, you have to know that this particular item will be causing a difference. So if this particular item will be causing a difference between the accounting profit and the taxable profit, then the company should either make provision for deferred tax assets or deferred tax liability. Let's take the first one. At year end, property, plant, and equipment had tax base and carrying value of 72 million and 95 million. So what amount is the 72 million? What amount?
22 million for the property.
What amount there?
That's the tax base.
That is the tax base, isn't it? And the
Yes.
carrying value is what?
Is the 95.
What is the difference?
So the difference is 23.
23. Okay.
23,000.
So that is a temporary difference, isn't it? Okay.
Yes.
So that is a temporary difference. The first one will be property, plant, and equipment. what will be the deferred tax on that? You first have to find the temporary difference. The temporary difference will be 95 million minus 72. The answer multiplied by the tax rate. What is the tax rate?
30%.
30%.
Okay. So this temporary difference now, will it be a liability or it will be an asset?
It's a liability.
It's a liability. Okay. Times 0.3. What are we getting? I'm getting 6.9.
6.9.
Okay. That is the first tax liability. That is the first tax liability. Let's count to a company's provision for decontamination cost was 11 million, appropriately discounted at the year end. Decontamination costs are tax deductible when was paid. What they are saying that they are tax deductible, it means that they will allow the company to subtract it from their profit before they will charge tax on the remaining figure. So who is paying the amount today? Who is going to pay the amount?
The tax authority.
No, the company is the one that will pay the cost, isn't it?
Yeah.
Yes.
And the tax authority is saying that they are going to allow them to subtract it before they charge tax. It's when the company is going to enjoy 30% tax benefit on that particular amount, isn't it?
Yeah.
But they are here to pay that amount. So whenever they pay it, what will be the tax benefit that they are going to enjoy? Let's make provision for that particular tax benefit today. That is what we call the deferred tax. So whenever we pay the 10 million, what will be the tax consequences of that? It means that we are going to enjoy 30% tax benefit on that cost because the company, the tax authority will allow us to take it from our profit before they charge what? The tax on the remaining profits. So we count the decontamination cost, the tax benefit on that. So the decontamination cost, that will be 10 times what? 0.3. You see that the tax authority is not having any amount. So the tax
11.
So it's 11.
It's 11, sorry. So this will be the temporary difference because the tax authority will be having 0 in relating to this amount. Okay. So that is a temporary difference. What will be the amount there?
3.3.
3.3.
And that will be a benefit. So we subtract it. That will be a deferred tax asset. So we subtract. Let's count to the company had inventory with carrying value of 24 million. This did not agree with the tax base because of 3 million written down value for obsolete what? Items. Tax relief is only granted for inventories upon sale.
Linus,
Yes, please.
please, the tax benefits, please, I don't get the explanation.
You don't get it.
Yes, please.
How
the
do you
11.
how do you want to get it? Because I don't understand, you don't
No,
get it.
you said the 11. So you said the 11 is a tax benefit, right?
Yes, please.
So she's asking how we got the 11.
The 11 is in the question.
Yeah, no, I know how you got the 11
Okay.
because you said the 11 is the company that is going to pay it, right? So
Yes.
how is it a tax benefit?
They
Or
will
is it
pay.
because they say it is deductible?
They will pay and they will subtract it from their profit before the tax authority will charge the tax on the profit.
Okay.
So if you are making a profit of 30 million, instead of the tax authority charging the tax on all the 30 million, they will allow you to subtract the 11. Then they will now charge the tax on what? The 19 million. So it means that if the 11 should, the cost of the 11, if you didn't incur it, the tax that you are going to pay would have been the 30% on all the profits. So since you are now subtracting 11, it means that you are what? You are enjoying 30%, which will be a tax on the 11. You are enjoying it. So that will be a tax liability. All right. That is what we are talking about.
Okay.
All right. Let's come to the inventory. So the question now is, who is suffering the loss? The inventory. Who is suffering the loss? Who is going to write the inventory as an obsolete inventory? Will it be the tax authority or the company?
The company.
It is a company, isn't it? All right.
Yes.
So you are saying that the value of your inventory is 24, but in the books of the tax authority is what, 27? Am I correct? Would that be 27?
Yes.
Okay. So instead of you subtracting 24 from your profit, the tax authority is telling you that subtract what? 27. So in the books of the company, they are having their inventory to be what? 24. So whenever we sell the inventory and we sold it for 100 million, we subtract the cost of what? 24 and now have a profit of what? 76. We, the tax authority, will charge at what? 0.3. But you are saying that no, whenever you sell the inventory, the obsolete inventory, which is the loss, subtract it from your profit. So it will now be 76 minus 3. Then the tax authority will charge tax on what? 73. So we are saying that they will charge it on 76. They are not charging on what? 73. It means that they are giving us a 3 million as an amount that we should subtract. So if we don't subtract the 3 million, we should have paid a profit of what? 0.3. We should have paid tax of 0.3 on the what? 3 million too. So if you are incurring a loss, so I want to say this too. If there is an impairment loss, the company will make provision for a benefit. The tax authority will allow them to subtract the loss. So the company will make a provision for the loss. If only the asset, the gain on the asset or the loss on the asset will be taxable after disposal. So we make provision for impairment loss too, if only the asset that is impairing is allowable for tax purposes. So the tax authority will be allowing the company to subtract additional 3 million from their profit before they will charge. So that will be giving a tax benefit to the company. So 0.3 times 3. What are we getting?
0.9.
0.9. That will also be a benefit. So we subtract, isn't it?
Yes.
Okay. Let's come to the last one. The last one. The company incurred 15 million in respect of new software development during the year, which was capitalized and will be amortized over the next 5 years. Full year's charge is required in the first year of completion or purchase. This cost was deducted in the current year for tax purposes. You see, what companies do is that whenever they are carrying out research and development costs, and they know that the development or the product that they are developing or the software that they are developing will be profitable, they will start capitalizing the development cost from the time that the management is convinced that the project is what? Feasible. But what will happen is that the tax authority, whatever research and development expenditure that the company is going to incur for that particular year, the tax authority will deduct all of them from their profits, and they will charge the tax on the what? On the remaining profits. But the 15 million over here, the company is going to what? Amortize it, and the company is going to capitalize it and amortize it over what? 5 years. So it means that every year they will be taking 3 million to what? Profit or loss. Meanwhile, the tax authority has already subtracted what? The 15 million from their profit, and they grant what? They charge the tax on what? On the remaining profits. The meaning is that after the first year, none of the 15 million will be subtracted from the company's profit again in the books of the tax authority. They are not going to subtract any amount of what? The 15 million again from their subsequent profit, because they have taken all the 15 million. They have taken all the 15 million from their what? Their profits. But the company is going to be taking only 3 million every year. So the tax authority will take all the 15 million, but the company will take only 3 million, because they say a full year charge is required in the first year. So the company will take 3 million to what? To their profit or loss. And the tax authority is taking all the what? The 15 million. the tax authority is taking all the 15 million. And the company will be having a balance of what? 12 million, which they are thinking that will be available that they are going to take from their profits before they charge tax. But the tax authority will not use any of what? The 12 million in the subsequent year. So the question now is the excess of the 12 million that the company is enjoying today, that they are not paying tax on it. In the future, what will be the tax complications on this 12 million that they are enjoying today in excess? So we try to look for the deferred tax benefit. What will be the future tax consequences of the benefit that we are enjoying today? If you're enjoying the 12 million today, it means that tomorrow the 12 million will not be there again. The tomorrow next, they are not going to give you the 12 million. You should have enjoyed the 15 million over 5 years, but they are giving the benefit for only 1 year. It means that all the remaining 4 years, you have enjoyed all of them in what? In this year. So in the remaining 4 years, those benefits will not be there and you are going to suffer for them. So if you want to know the deferred tax on this development and expenditure cost, you are going to look for the temporary difference. The tax authority is charging all the 15 million and the company is only charging 3 million because they say this will be amortized over 5 years and a full year charge is required in the first year. So what will be the amortization for the first year? It will be 3 million, which will be taken to profit or loss. But the tax authority is taking all the 15 million. It means that the tax authority is granting capital allowance on excess what? 12 million. So that 12 million, what will be the tax implication of that? So software development, we are going to have the remaining amount because the tax authority has already taken 3 million out of that. So we have 0.3 times 12 million. What will be the difference? What will be the deferred tax on that? 0.3 times 12 million.
3.6.
Would there be a liability or it will be an asset?
Liability.
Asset.
Are you sure? You are saying that I should give you 15 million over 5 years. And for you, you have come for all the 15 million in 1 year. Will you come for remaining of the 15 million in the next 4 years? Will you come for that one again?
No.
No. So it means that whatever you are going to do in the next 4 years, you have to go and set for a different money. You have to suffer for it. You have to sacrifice it. So what I want to say is that mostly determine whether this is an asset or liability is a problem. But I want to give you the simple way of doing it. If it is the company that is suffering currently as a result of the issue, it means that in the future the company is going to be enjoying. So that will be a benefit in the future. But if it is a company that is enjoying today, it means that this benefit that they are getting today will not be available in the future. So they are going to suffer. In that case, that should be a liability. So if it is a company that is going to suffer for what is happening today in the future in terms of tax, then that should be a deferred tax liability. But if it is a company that is going to enjoy in terms of what? Tax in the future, then that should be a benefit, deferred tax what? Asset. So if you look at this, you see that it will be the company that will be suffering because they are enjoying all the 15 million today, which should have been enjoyed over 5 years. So the second year, the third year, the fourth year, they are not going to get anything on this particular research and development expenditure again because they have taken all the 15 million in 1 year. So they have to be ready to suffer for the remaining 4 years. So in the remaining 4 years, what would have been the tax that a company will be paying over the remaining 4 years? That is the provision that we are talking about. So we made the provision for the entire remaining years or the entire useful life of the what? The asset or the project. Okay. What will be the net amount, which will be the deferred tax liability? The net amount will be the deferred tax liability. The net amount will be the deferred tax liability.
6.3 million.
6.3 million. So that is the net deferred tax liability. The question says you should calculate deferred tax liability. So you can do all of this and show this one as a net deferred tax in the statement of financial position. And you also add this one to your current tax if they should give you a current tax in that situation. Let's look at question 13, then we end it here. Question 13. Question 13.
Eunice.
Question 13. So the carrying amount of Julian's property, plant and equipment at 31st December 2003 was 310,000, and the tax written down value was 230,000. The following data relates to the year ended 31st December 2014. A. At the end of the year, the carrying amount of property, plant and equipment was 460,000, and the tax written down value was 270,000. During the year, some items were revalued by 90,000. No items had previously required revaluation. In the tax jurisdiction in which Julian operates, revaluations of assets do not affect the tax base of an asset or tax profit. Gains due to revaluation are taxable on sale. B. Julian began development of a new product during the year and capitalized 60,000 in accordance with IAS 38. The expenditure was deducted for tax purposes as it was incurred. None of the expenditure had been amortized by the year end. The corporate income tax rate is 30%. The current tax charge was calculated for the year as 45,000 required. With reference to the relevant IFRS, recommend how the above transactions should be accounted for in the financial statement of Julian for the year end 31st December 2014.
You can see that this is a very interesting question. You see, income tax question is always very interesting. Okay. You see, at the beginning of the 2x4 year, you can see that you are giving opening balances for the carrying value and also the tax base, isn't it?
Yes, sir.
Okay. You know why they have given you those figures?
No.
Now they have given you those figures to know your opening deferred tax was balance. So that you look for the new one and look for the movement in the deferred tax. So those figures are given to you over there to know your opening deferred tax was balance. So let's calculate the opening deferred tax balance first. Opening deferred tax balance. The opening deferred tax balance. So the opening deferred tax balance will be calculated as the difference between the two. Okay. The carrying value is what? 310, and the tax written down value is what? 230. So what will be the difference between them?
80,000.
So 0.3 times the temporary difference of 80,000. Okay. What will be the
24,000.
Okay. So this is our opening deferred tax liability. The carrying value is higher than the tax base. The company is enjoying more capital allowance than they are depreciating the assets. So the opening deferred tax will be a liability. Okay, let's take the A. At the end of the year, the carrying amount of plant and equipment was what? 460,000, and the tax written down value. Okay, a minute. Okay. So At the end of the year, the carrying amount of property, plant, and equipment was 460,000, and the tax written down value was what, 270. During the year, some items were revalued by 90,000. No items had previously required revaluation. In the tax reduction in which Julian operates, revaluations of assets do not affect the tax base of an asset or taxable profits. Gains due to revaluation are taxable on sale. What they are trying to say is that they are trying to tell you that the 90,000 over there is not part of the 270,000 that you are saying there, because the revaluation does not affect the tax base. So the tax base over there, which is the 270, is purely relating to only profit and loss items. Okay, it's purely relating to profit and loss items. So let's count to 2x4. What will be the temporary difference? What will be the total temporary difference? 2x4. What will be the total temporary difference? It will be 460,000. It will be 460,000. 460,000 minus what? 270. Am I correct? Would that be the total temporary difference for 2x4?
Yes,
Okay, that will give us how much?
190,000.
Okay, but out of this amount, 90,000 relate to what?
Revaluation.
Revaluation. So out of that amount, 90,000 relate to revaluation. So we have to come and share these amounts now. So 90,000 will be for OCI, and 100,000 will be for what? Profit or loss. So because the revaluation was added to the what? The carrying value of the asset, but it was not added to what? To the tax base. So the tax base over here is as a result of what? Differences in the profit or loss item. So you have to charge profit and loss items against the tax base. Someone can also subtract the 90 from the 460 before subtracting the 270 from it to get the difference that is relating to profit or loss. Or you can calculate the total amount and now ask yourself, which portion of it is relating to OCI? Which portion of it is relating to the revaluation? The remaining portion will go to profit or loss. Okay, so our deferred tax will now be calculated in two forms. So deferred tax will now be calculated in two forms. The first one will be 0.3 times 100,000 profit or loss. I'll be getting 30,000. Is that correct? The second one will be other comprehensive income, which will be 0.3 times the revaluation surplus. What are we getting there?
27,000.
Okay. The new revaluation, the new deferred tax for profit or loss now is what? The new deferred tax provision for profit or loss is now what?
30,000.
But what was the previous balance? What was the previous balance relating to profit or loss?
24,000.
24,000. So what will happen is that we count to current tax schedule. Current tax schedule. Okay. We count to the current tax schedule. So you can see that you are giving the current tax estimate in the question. So the current tax, what is the current tax in the question? 45,000. So we count to the movement in deferred tax. Movement in deferred tax. That will now be 30,000 minus 24,000. You can see that this is increasing, isn't it? So it will be added. It is increasing. That will be added. But the 27,000 will be taken to other comprehensive income, because the revaluation surplus will be in other comprehensive income. So whatever the other comprehensive income is, take the deferred tax over there. The 30,000 is as a result of depreciation, the difference in the depreciation. So since depreciation will be taken to profit or loss, then the deferred tax relating to the differences in the depreciation should also be taken to profit or loss. So the 27,000 will be taken to other comprehensive income. So it will not form part of our tax schedule. The tax schedule, we are only looking for the tax that we take to profit or loss. So we are going to keep the 27,000 for now and count to the B. Count to the B. Julian began development of new product during the year and capitalized 60,000 in accordance with what? IAS 38. The expenditure was deducted for tax purposes as it was what? Incurred. None of these expenditure had been amortized by the year end. The corporate income tax of this is 30%. So you can see the company began a development of a new product and the amount was capitalized. They haven't expensed it. They haven't subtracted from profit. But the tax authority has subtracted the full amount from what? Their profits before charging tax. But we are keeping it in our books. It means that we are enjoying all the 60,000 now, which we are thinking that will be enjoyed over a number of years. But we need to amortize the 60,000. We still have the 60,000 in our books. So since we are enjoying all of them today, what will be the tax consequences of the 60,000 that we should have written against our profit today, but we are keeping it? What should have been the tax consequences of keeping it for some number of years? That's what we are coming to look at. So in the books of the tax authority, they are not going to have any amount relating to the development because they have written all against the profit of the company. But the company is still having the 60,000. So in this case, the temporary difference will be all the 60,000. All the 60,000. So let's calculate the deferred tax on the development. So the deferred tax on the development cost. Deferred tax on the development cost. So the deferred tax will be 0.3 times 60,000. How much are we getting?
18,000.
Okay. This 18,000, is it going to be a liability?
Yes.
Yes. Okay. So this will be taken to profit or loss because the expenditure, the development expenditure will be taken to profit or loss. So deferred tax relating to that will be 18,000. Deferred tax relating to that will be 18,000. So if you add all of this, then that will be the tax that will go to your profit or loss. So if you count to other comprehensive income, the other comprehensive income, you take your revaluation surplus, the total revaluation surplus of 90,000. Then you subtract your deferred tax from it. Your deferred tax from it of 27,000. Okay. If you count your statement of financial position, what will happen is that you are going to have your assets. You are going to have your assets, which is property, plant, and equipment. The value will be 460,000 because that is the closing balance given to us. Okay. Then you have a development expenditure. You have a development expenditure or development cost of what? 60,000. Okay. Then if you count to liability, you have your current tax of 45,000. 45,000. Then you have your deferred tax liability of 30,000 plus 27,000 plus 18,000. That will be your total deferred tax. The one relating to profit or loss was 30,000. The new provision was 30,000. The other comprehensive income was 27,000. And deferred tax on the development expenditure was 18,000. So you put all of them together to have your total deferred tax. Then you count to equity. The equity, you have your revaluation surplus of the net, which is 90,000 minus the 27,000. What are we going to have there? Would that be 63,000? All right. So that is how you are going to show this. That's how you're going to show this. What I'll do is I'll try the question 11. I wanted to solve that, but it's 8 something. I have to close. All right. All right. So that is all about that particular question. That is all about that particular question. And we thank God that we have come to the end of this one. Next week, we look at impairment and non-current asset held for sale. We look at the two of them and come and solve questions on the two of them two at once. All right. Any question? Do you have any question?
No question.
Okay. If there are no questions, then thank you for coming. I'll see you next week.